All right, let's jump right in. Today, we're doing a deep dive into one of the most powerful and honestly, one of the most popular day trading strategies out there, the Opening Range Breakout, or ORB for short. It's a method that's all about capturing that first big, explosive move of the day. We're going to break down exactly how you can use it, whether you're trading stocks, futures, or even crypto like Bitcoin and gold. So here's the game plan for today. We're going to start with a why, the actual statistical reason this strategy even has an edge. Then we'll define the core concepts, walk you through the exact setup, and, most importantly, cover the little details and filters that separate the pros from the amateurs. After that, we'll look at some real trades and wrap it all up with a simple checklist you can use every single day.
First things first, why all the focus on the market open? Well, you've got to understand that not all hours of the trading day are created equal. That first 30 to 60 minutes, that's the main event. It's where the big institutions, the hedge funds, they're all establishing their positions. And that initial battle often sets the entire tone for the rest of the day.
So you might look at all that crazy volatility at the open and think, man, this is just random noise. It's a coin flip. But what if it's not? What if all that initial chaos is actually handing us a statistical edge? What if it's a roadmap for where the price is headed? You know, the entire foundation of the ORB strategy is built on a very real, quantifiable pattern. Research has shown time and time again that the market open is anything but random. It actually has a huge statistical significance. For instance, studies show that the direction of that first half hour of trading often predicts the trend for the entire rest of the day. Now check this out. This chart right here visualizes a famous study by Grimes, who crunched the numbers on thousands of trading days. And the conclusion is crystal clear. Way more often than not, the opening price ends up being right near the high or the low of the entire session. That's a huge piece of information. It tells us that the initial move isn't just a head fake, it often dictates the daily trend. Okay, so we've established why the open is such a big deal. Now, our next job is to actually define the battlefield itself, and that's what we call the opening range. So, what exactly is the opening range? It's actually super simple. It's just the high and the low that's established within a specific period right after the market opens, say the first 15 or 30 minutes. You can think of it like an indecision zone. It's where the buyers and sellers are slugging it out, and the break from that range gives us our first major clue as to who won that initial battle. Now, you do have a choice to make here. You could use a 5-minute range, which is super aggressive. It gets you in on the action early, but man, it can be really noisy and full of fakeouts. Most experienced traders, though, they find that a 15 or 30-minute range gives a much better balance. It helps filter out all that initial choppy price action and forces you to be a little more patient, waiting for a much more confirmed move.
Okay, we understand the why and the what. Let's get into the how. This is the nuts and bolts, the mechanical, step-by-step process for actually putting on a basic opening range breakout trade.
This is the core process, right here. It's simple but powerful. Step 1. You left the range form, and you mark the high and the low on your chart. Step 2. You wait patiently for the price to break out. Step 3, and listen up because this is absolutely critical, you have to wait for a full candle to close outside that range. A wick that just pokes through and pulls back, that's a classic trap and it doesn't count. Only after you get that confirmed close do you even think about entering the trade with your risk already defined. But of course, if trading were that simple, we'd all be rich, right? Just blindly trading every single breakout is a surefire recipe for mediocrity. The real key to making this strategy work consistently is learning how to filter for the high probability setups and, just as important, how to avoid all those nasty false breakouts or fakeouts. And this quote right here just hits the nail on the head. A trading strategy isn't something you just follow blindly out of the box. It's a starting point. We have to add layers of context and confirmation to really stack the odds in our favor. This is what separates professional traders from the crowd. So the key here is looking for what traders call confluence, where multiple factors all line up and point in the same direction. Is the breakout happening on a huge spike in volume? That's a great sign. Does it agree with the overall daily trend? Is it breaking above or below a key indicator like VWAP? Now VWAP, or volume-weighted average price, is huge. You can think of it as the true average price. A break above VWAP tells you buyers are in control, while a break below suggests sellers are winning. And finally, is there a real reason the asset is moving, like a news catalyst? When you can get check marks next to a few of these, your probability of a successful trade goes through the roof.
Theory is one thing, but seeing it all come together in the real world is where it really clicks. So let's walk through a couple of actual trades, bar by bar, to see this strategy in action in a couple of different markets.
All right, first up, let's look at a short trade in gold. And remember, context is everything. Before the New York session even opened, some strong economic data came out. That's usually great for the US dollar. And since gold is priced in dollars, a stronger dollar almost always means weaker gold. So right off the bat, we had a clear bearish bias. We were only looking for reasons to get short.
I mean, this is just a textbook A+ setup. The bias was bearish because of the news. The opening range formed below VWAP, another bearish sign. The entry only came after a confirmed candle close below the range low. And that confirmation, it was beautiful. The breakdown happened on a massive volume spike. The stop loss was placed logically, and profits were taken at a predefined support level and a 1 ATR extension. An ATR, or average true range, is just a way of measuring volatility. Using it for a target helps you set a realistic goal based on how much the asset normally moves.
Now, let's flip it and look at a long example in Bitcoin. Here, the context was bullish. The market had been pretty weak, so you can bet a lot of traders were short, betting on more downside. But then, a positive regulatory story broke overnight. That's a catalyst. And this created the perfect storm for a potential short squeeze. That's where all those short sellers get scared and are forced to buy back their positions, which just adds fuel to the fire and sends the price rocketing up. Now, this trade is a fantastic example of trader psychology in action. Bitcoin formed this really tight range right above VWAP. That's bullish. It tried to break out a couple of times and failed, but here's the crucial part. It refused to sell off. That tight consolidation near the highs was a massive clue that buyers were just sitting there, absorbing all the selling pressure. So when the breakout finally came, it was on an explosive volume spike. The entry was clean, with a tight stopper right below that powerful breakout candle. Perfect.
So to really simplify things, you can use this table as a quick cheat sheet when you're live in the market. A real high probability breakout has big volume, a strong candle close, and it's aligned with the bigger picture. A fake out? That's usually got weak volume, just a wick poking out, and it's often fighting against the main trend. Knowing the difference is a game changer.
And this quote from Mike Bellafiore, a top trading firm manager, it just hammers home the most important part of all of this. Discipline. The fear of missing out, FOMO, is the biggest enemy of every trader. It's going to scream at you to jump in before the setup is fully confirmed. Resisting that urge and patiently waiting for your rules to be met, that's what builds long-term consistency.
All right, we have covered a ton of ground. We've gone through the theory, the filters, and the real-world examples. Now, let's put it all together and distill it down into a simple, actionable checklist that you can use before every single trade. Think of this as your pre-flight checklist. Before you even think about clicking that buy or sell button, you should be able to answer yes to every single one of these questions. Let's run through them. Bias, are you trading with the wind at your back? Catalyst, is there a real reason for this thing to move? Range, have you objectively marked your levels? Confirmation, are you waiting for proof, not just hoping? Confluence, do other factors support your trade? And finally, the big one, plan, do you know your exact entry, exit, and stop loss before you get in? This isn't just a list, it's the routine that builds discipline and keeps you out of trouble.
You know, we focused a lot on the New York and London opens today, but these principles apply everywhere, to stocks, forex, crypto, whatever you trade. The key is just to find that high volume open for your specific market. So I'll leave you with this question. Which session's opening range do you find most effective for the ORB strategy, and why? I'd love to hear about your experiences, so drop them in the comments below. Thanks for tuning in.